Welcome everyone to the Ross Parsons Centre for Commercial, Corporate and Taxation Law at Sydney Law School. My name is Jason Harris. I'm Professor of Corporate Law at Sydney Law School. This is a series of what we're calling the Law and Business Downtown Seminar Program. It's something that many of you would be familiar with. We've been running them for many years here at Sydney Law School, usually face-to-face, but this year, due to the pandemic, we've switched them over to webinars. And one of the great things about the webinar format is that we're able to draw in a lot more people from outside of Sydney, including speakers. So tonight we're going to be discussing repacking the pre-pack. What's the future for connected party sales and administration? Tonight's seminar is going to be focused primarily on UK law and developments in UK law. And I'm delighted to introduce our speaker for this evening, which is Chris Umfreville. He's a lecturer at Aston University in Birmingham in the UK. He's written widely in the area of corporate insolvency and corporate rescue and has conducted a number of research projects on behalf of the Insolvency Service as part of the Graham Review into pre-pack administrations and also for R3, including a 2018 project in conjunction with the Institute for Chartered Accountants for England and Wales. Have I got the acronym right there, Chris?
Yeah, perfect.
On CVAs, company voluntary arrangements, where he was looking at their success and failures. And he's also published work in a number of academic and practitioner journals and is a contributing editor for Palmer's Company Law. Our commentator for tonight is Mark Wellard, who's a senior lecturer in the UTS Faculty of Law. Mark's had a diverse career prior to coming to academia. He worked for one of Australia's largest law firms, specialising in litigation and insolvency law. He's also previously been the legal director for ARETA. So for those who are coming from overseas, that's the Australian Restructuring, Insolvency and Turnaround Association, which is the peak professional body for insolvency practitioners and turnaround managers in Australia. Mark has published extensively on insolvency law in both industry and academic journals. And one of the things that many of the people on the line would no doubt be familiar is Mark's empirical work around deeds of company arrangement, where one of the things from memory, Mark, you looked at in your report was if there was an asset sale, who was buying the assets. And Mark's also published specifically on pre-packs with a British author. So this should be an interesting discussion. The pre-pack topic is something that comes up periodically in Australian insolvency law reform debates. Certainly at the moment, we're all scratching our heads thinking about what's the best way to proceed in terms of dealing with the fallout from the pandemic. And so we're certainly looking for options in offshore jurisdictions. And so we're looking forward to hearing from your experience, Chris, as to how the UK has worked with pre-packs over the last few years and what might be coming in the future. So thanks everyone, and I will hand over to you, Chris.
Great, thanks, Jason, and thanks very much for the invitation to speak tonight and to join you, and thank you to Mark as well for commentating. So I'm just going to share my screen and give you the slideshow. Hopefully that's working for you. I'm also just going to stop my my video while I present, just so that I don't sort of use up any unnecessary bandwidth, if that's okay. So yeah, good evening everyone, or good morning. It's weird hearing Jason say good evening when I've not long been awake, but yeah, it's really good to join you. And yeah, one of the upsides of the current situation that we can have an event like this and share some thoughts on current developments in insolvency law. So this evening, as Jason alluded to, I'm going to talk about repacking the pre-pack and the future of connected sales in administration. And we'll consider what a pre-pack is, for those of you that haven't come across the term before or aren't that familiar with it. We'll also think about what reforms or attempted reforms we've seen in the recent past and what the impact of those has been. And then we'll think about where we are now. So we're 6 years on from the Graham Review that Jason mentioned in his introduction. And we'll think about the impact of those reforms and also then, therefore, what next in the current situation. So first of all, what is a pre-pack and how did it come to be? Well, the best definition for a pre-pack can be found in Statement of Insolvency Practice 16, which states that the term pre-packaged sale refers to an arrangement under which the sale of all or part of the company's business or assets is negotiated with a purchaser prior to the appointment of an administrator, and the administrator effects the sale immediately on or shortly after appointment. So in essence, this is a process whereby the negotiation for the transaction, marketing of the business sale, the valuation, preparation of contracts, and everything on that basis is conducted before the administrator is appointed, and then fairly soon after the appointment, the administrator executes the sale agreement, the business is sold to the new company, and it provides an almost seamless transition for the business, so real sort of continuity benefits there. Importantly, there's no statutory definition or provision for pre-pack administration. That's why I referred you to the Statement of Insolvency Practice for the best definition, because we don't have one on a legislative footing. On some levels, therefore, this almost seems at odds with what the legislation is seeking to achieve. So if we go back to the underpinning statute, which is the Insolvency Act 1986, and we look at Schedule B1, paragraph 3, it states that the three purposes are firstly to rescue the company, secondly, likely the company wound up, or finally, if you can't achieve those two, realise the property secured or preferential creditors. And we see in this this set of objectives the importance of the outcomes for creditors, whilst rescuing the company concerned with the primary objective, makes it clear that if the administrator thinks that the second objective, the best result for the whole, than rescuing the company going concern, then they can prioritise that. Asset orderly wind down. However, the importance of creditors is also seen if we look to paragraphs 49 and 51, that requires proposals to be sent to and approved by creditors within 10 weeks of appointment. So one of the key things there is, how does that fit with this idea of an immediate sale? So you're cutting the creditors out of that discussion. How do we get here then? Well, through a state of evolution, really. So the concept of an early sale to maximise returns to creditors was acknowledged and even approved in Re-T&D Industries 2001, whereby the court acknowledged that sometimes waiting until creditors had the opportunity at that stage in a physical meeting to move the plan could result in the diminution of the value of the company and therefore be worse for the creditors. The court, though, said that it wasn't some form of bomb shelter to provide reassurance. The administrators had to take commercial decisions what they thought was best in the circumstances. So that gave the authority for administrators to sell the business prior to having that full approval from the creditor. In the UK, we had major reform to the administration process in the Enterprise Act 2002, which came into force the following year. And the principle in Re-T&D Industries around an early sale was confirmed to continue to apply in Re-Transverse International in 2004.
Sorry, Chris, could I just interrupt for a moment?
Yes.
I'm not sure if you're flicking through your slides, but I can still only see the first slide.
Yeah, I've tried to keep the slides to a minimum, if that's okay.
Oh, wonderful.
Jason.
Okay,
So, yeah,
I thought there might have been a glitch on my system. Sorry.
No, you're okay. Thanks for raising it, because no doubt we'll probably encounter something, but no, not so far. Okay. So once the court had approved the principle of an early sale, combined with the second major reform of the Enterprise Act reforms, that you could have an out-of-court appointment of administrator, it was a logical conclusion that you could therefore have a really early sale. And that was approved in Re-DKL Solicitors 2007, that the concept of the pre-pack was approved by the courts. So the process offers lots of benefits, but is also subject to criticism, and it's a delicate balancing act. Benefits include the rescue of a business, which can maximise value, therefore achieving the best return for insolvent companies' creditors, and also preserving jobs. However, the trade-off for this is that the speed of the process, and the discretion that's afforded to the IPs, means that creditors can be left in the dark, as they only really find out about the pre-pack once it's taken place. Now, there's a good reason for this. Publicising the fact that the company is in financial difficulty before the sale could undermine that sale and the value of the business, which in turn would undermine the returns to the creditors. Also, the benefits of the pre-pack is that it could result in a cheaper process than if you tried to trade the business through the administration process, again maximising returns. However, despite these benefits, it hasn't been without criticism since it emerged in the late noughties. So the lack of transparency, the failure to protect creditors, because often unsecured creditors get little or nothing. There's potential conflict of interest with the administrator acting pre and post appointment, And it's argued as well that there's a disadvantage to solvent competitors. So in the past decade, we've seen attempts to balance this desire for transparency and reassurance for creditors, whilst also preserving the positive outcomes. And we've seen various reforms and reform proposals to address these, but as we'll see through the process of this evening's presentation, we're not quite there yet. So, reforms, we've had a few. So in 2009, we saw the introduction of SIP 16, where we got that definition of the pre-pack from. And this provided insolvency practitioners with a set of standards they had to adhere to when involving themselves in a pre-pack, particularly around the disclosure of information to creditors. The idea behind this was that creditors would have better and quicker access to the relevant information, so it was required to be sent out within a week of the transaction taking place. So the creditors weren't involved in the approval, but at least they didn't have to wait until the proposal was sent out 8 weeks after the appointment to find out what had gone on. The principles in the Statement of Insolvency Practice 16 are aimed at alleviating concerns of abuse and create greater confidence in the marketplace around the use of pre-packs. The filing of SIP 16 statements by the insolvency practitioners slowly took hold, but now it's a part of regular practice, and we see a high compliance rate according to the annual Insolvency Services reviews of IP regulation. Despite the introduction of SIP 16 in 2009, there were still concerns about the use of the pre-packs. And in March 2010, the Labour government started a consultation on improving transparency of pre-packs. And they identified 5 possible options. One was just carry on as we are. The second was to enshrine SIP 16 in statute. They also considered making it compulsory to go into a compulsory liquidation after the pre-pack to ensure that the official receiver scrutinised the transaction. Or you could have different insolvency practitioners involved prior to post-appointment. Or finally, perhaps requiring court or creditor approval where the transaction involved a connected party. There was a lot of concern in the industry, in particular around these proposals, and there was a lot of delay following the consultation. We had a change of government in May 2010, and then the new government in 2011 suggested that they might take action to address connected party sales. However, these plans were then abandoned in January 2012. That then takes us to sort of the focus of the key part of today's presentation is the Graham review into pre-pack administration. The ball started rolling on this when Vince Cable, the Secretary of State for Business, commissioned Theresa Graham to undertake an independent review of pre-packs as part of the government's Transparency and Trust agenda. The review was published by Theresa Graham in June 2014 and was underpinned by the Wolverhampton report, which is the report that Jason mentioned that I was involved with, along with Mark's British co-author Peter Walton from the University of Wolverhampton, hence the Wolverhampton report referred to in the Graham Review. And this is an empirical study of the outcomes of pre-pack administration that commenced in 2010, so a longitudinal study as to the outcomes, together with a counterfactual looking at trading administrations where there was a sale of business going concern in the same year, to compare the outcomes of each of those. So what was the outcome of the Graham Review into pre-pack administration? Well, Theresa Graham found that there was a place for pre-packs in the UK's landscape. She didn't recommend the banning of pre-packs, but saw that the benefits of pre-packing to the UK insolvency framework means that the reform of the process was worthwhile. And she said there could and should be some major improvements as to how they're administered. She detailed in the report a number of positives, such as the preservation of jobs, the fact that it's a relatively cheap insolvency process. Whilst the use of deferred consideration was raised as a potential concern, the report identified this was usually paid. This is a potentially contentious matter, as I'll touch on later on, as there can be some negative effects around this. And she also noted some wider economic benefits, touching on the bankruptcy tourism aspect there. Theresa Graham set herself out as a deregulator at heart and didn't think the government should legislate other than as a last resort. Instead, she set out 6 recommendations for the industry to follow on a voluntary basis. These are set out on the slide. So the first 2 are key recommendations, were the creation of the pre-pack pool and the completion by the new co-purchaser of a viability review. Alongside that, she suggested a revised form of SIP 16. The requirement that the insolvency practitioners complied with 6 principles of good marketing and reported the fact that they did, and if they didn't, why they deviated from that. The requirement that there was a valuation of the business and assets by a valuer who held professional indemnity insurance, and also that monitoring of the 616 statements use and compliance was transferred from the insolvency service to the professional body that oversaw insolvency practitioner regulation. So, on introducing these reforms, Theresa Graham said that, "I believe that implemented as a complete package, my proposal will lead to real improvements in pre-tax, will help preserve jobs and contribute to the UK economy as we emerge from the recession." So let's focus on these reforms, and in particular the first two, the creation of the pre-pack pool and the viability review of new companies. These are the key recommendations. Now, just before we go on to look at these, it's worth remembering that in case the measures weren't appropriately adopted because they were proposed on a voluntary basis, Theresa Graham did suggest that the government take a reserve power to enable legislation to be introduced. And that was known as the sunset clause, but more of that later. So, the reforms. The main one was the introduction of the pre-pack pool. Well, what is it? As this website makes clear, the pool is an independent body of experienced business people who offer an opinion on the purchase of the business and or its assets by connected parties to a company where a pre-packaged sale is proposed. So, nice, clear, succinct overview there from the pool. So how does it work? Well, a referral to the pool is on a voluntary basis, not by the seller or the insolvency practitioner, but by the purchaser. So the entity that's buying the business from a connected party using a pre-pack has to voluntarily refer itself to the pre-pack pool for an opinion. Now, the insolvency practitioner is required to make the purchaser aware of the existence of the pool and what it's there for, but it's for the purchaser to determine whether or not it wants to apply, and also to determine what information should be provided. So there's clear guidance on the pool website as to the type of documentation it would expect to receive, but there's no mandated requirement. Rather, the purchaser provides information such as it considers necessary, hopefully in line with the recommendations on the website. Now, one of the concerns about these sort of oversight mechanisms being introduced is that they could slow down what is a pretty quick process. However, the pool aims for a quick turnaround, returning an opinion within 2 business days, and also a relatively low cost. So it's currently £950 plus VAT, which is around 2,000 Australian dollars. That's gone up slightly. It was around £800 plus VAT when it was first introduced. There are 3 possible outcomes that the pool could give, so 3 opinions. So first is that the proposed transaction is not unreasonable. That's a positive outcome. Then the second is that it's not unreasonable, but there are limitations in evidence. So mildly positive, but obviously there's a suggestion that the documentation hasn't been submitted there. And then the final opinion is that the case hasn't been made. So a relatively low threshold there, but also not sort of negative. Even the negative outcome isn't saying that the pre-pack shouldn't go ahead, just that there hasn't been a case made for it to go ahead. Ultimately, even if a negative opinion is provided, that won't prevent the sale going ahead. It's up to the insolvency practitioner whether they want to proceed. So what's the uptake of the pool been? Well, pretty low use, as we can see on the first chart here. So we've only got data from the first year of its use. So the pool came into existence on the 1st of November 2015. So we've got data for 1st November 2015 to 31st December 2015. And then the calendar years 2017 and 2018. We can see that in the first year or 14 months, that 28% of eligible cases were referred to the pool. So we had around 370 pre-packs in that period, of which about 188 were connected parties, but only 53 were referred to the pool. That percentage drops as we go through sort of 2017 and 2018 to 11% of eligible cases in 2017 and then just under 10% in 2018. We haven't seen any published figures for 2019, or obviously 2020 was still ongoing at the moment. But I understand from the pool that there have been 21 referrals this year following a recent rash of referrals. as it was reported in the media that there had only been 10 referrals up to around June. However, importantly, we don't know what proportion of all pre-packs this represents, and given the current economic climate, there are more pre-packs taking place. So we don't know how many of these aren't being reported to the pool at this stage. The second chart shows us the outcome of the pool referrals, and as we can see, where it is used, the opinions are mixed, but on the whole positive. So the first two bars, the blue and the red, are not unreasonable or not unreasonable, but evidence, and those are by far and away the majority of the opinions that are provided. So a few case not made decisions forward as well. So we see relatively low use of the pre-pack pool. Is that really surprising? Well, I'd argue that it isn't, and there are various reasons for that. So firstly, the cost, although around £1,100, $2,000 is not a huge amount of money, why pay that extra £1,000 you don't need to as a purchaser? The Graham review revealed that the median purchase price for pre-packs in 2010 was around £5,000. 3/5 of the pre-packs involved consideration of less than £100,000. Some further research that I conducted recently into pre-packs that took place in 2013 with connected parties looked at a sample of 120 such sales, and the median purchase price had dropped £46,500, and 3/4 of the transactions the purchase price was less than £100,000. So in the context of these prices, £1,000 is quite a lot of money. So in the context of a struggling business, debt rollover, you've got to pay legal fees, you've got to cut costs, why would you pay more? Time also comes into it. So Nick O'Reilly, a former insolvency practitioner and now an associate director at Manolete, recently published an article on LinkedIn which identifies a number of time pressures facing a newco in a connected party transaction. So you've got to register the company, register it for VAT and pay as you earn tax with HMRC. You've got to instruct lawyers, you've got to approach lenders, liaise with customers and suppliers. And arguably there's just therefore not quite enough time to add in something which is purely voluntary. And then finally, the decision itself. As we saw, the decision isn't binding, so even if there's a negative outcome, the insolvency practitioner can choose to proceed with the sale. So does it really matter why getting an opinion from the pool, therefore? We don't yet have any substantial longitudinal data on the outcomes of the processes to determine the success of the pool opinions, and in any event, the sample sizes we can see are relatively low. The purchase survival rates for the first year of the pool appear consistent with previous statistics, but with the caveat I've just stated. And also it's important to bear in mind that we would need to compare that with other pre-packs in the same years rather than pre-packs that took place in 2013 because of the different economic environments. What then about the other reforms that occurred? So the second key reform was the introduction of the viability review. And in the Graham review, it sets out the background for this. And it's quite clear that the insolvency practitioner's requirement isn't to look into the future viability of the new business that's emerging from the sale. Rather, their responsibility is to credit the old company that's gone into administration. However, the public perception and research suggest that future viability, especially in the case of connected party pre-packs, is a concern for both transferring suppliers and new ones. Now, Teresa Graham said that more could be done to demonstrate the potential viability of the new business or company emerging from the pre-pack. Hence the introduction of the viability review, but much like the pool, but perhaps worse, I suppose, it's turned out not to have a great impact. Again, it's voluntary, and the insolvency practitioner has to report on whether or not they've been submitted. Data from the Insolvency Service's annual review of IP regulation shows relatively low uptake. So in 2015-16, only 37 party pre-packs included the viability review. That's just 19% of all connected party sales. In the 2017 annual report, the Insolvency Service doesn't make reference to viability reports. And then in 2018, we see that there are 31 connected party pre-packs where viability review is included, dropping down to just 12.9% of all party sales. It represents a problem for creditors, especially unsecured and NewCo creditors. If the NewCo isn't viable, then it could collapse. We've seen in the Graham review there was a higher rate of failure for connected party sales than non-connected. There's also risks of recidivism. As Lord Mendelsohn recently observed in a debate in the House of Lords, he set out one of his research team to look into tracking companies that went into pre-pack to search for trends or other things that might provide information. And his researcher found one business that he claimed has essentially been through 11 pre-packs in 6 years, marginally changing the name on each occasion, but with no change of directors. And he says, anything that allows such a practice to continue is clearly wrong. But I'd argue it's hardly surprising that the directors wouldn't submit a viability report. In the Graham review, it states that should the purchaser subsequently fail, the viability statement could be available for consideration by the insolvency practitioner to assist in assessment of the conduct of the purchaser's management and ascertain whether action should be taken against them, such as for wrongful trading. So essentially, a purchaser who submits a viability review is potentially digging their own grave. What about the other reforms that were introduced? Well, one of the other leading reforms was the introduction of the requirement for following marketing principles. A key issue of transparency for connected party pre-packs was whether they were properly marketed, and there were doubts raised about this in the Graham review. There's some data provided again in the Insolvency Services Annual Review of IP regulation, although this is presented in a very limited fashion. So we see that in 2015-16, 290 SIP16 statements refer to there being marketing carried out, but there's no delineation as to whether those were connected party sales or not. There's no data in 2017 again, and then in 2018 this is up to 394 SIP16s state that marketing took place. However, the key thing is that we don't know whether these were connected party sales or non-connected party sales, and the concern is that, raised by the Graham review, that IPs were relying on information given to them by the existing management that marketing had been conducted and there was no other interest in the business, and that could lead to potential abuse. Without a sort of closer review of the SIP16 statement, it's hard to see the success of it. Companies, insolvency practitioners also required to use a value of professional indemnity insurance. Is the best price achieved? They have to report on this fact in their SIP16 statement, but again, we don't have any clear published data as to whether or not that has been done clearly. There are also further potential issues with this. Just because a valuer has professional indemnity insurance, does that make them the right person for the job? As we saw in the recent case of Brewer and Iqbal, some valuable IP assets were undervalued. So there's still some issues there. And some final measures that were introduced was the revised SIP16, which was in essence adopted, and that the recognised professional bodies monitor themes, which again has taken place. So by and large, all of the Graham review reforms were introduced, but to sort of differing rates of success. So you mentioned a moment ago that Theresa Graham recommended the government reserve the power to legislate if industry-led measures didn't work. And this led to the introduction of what's on your screen now, a sunset clause in paragraph 60A of Schedule B1, introduced by the Small Business Enterprise and Employment Act in 2015, allowing the government essentially to make a decision in respect of disposal of connected parties wider than pre-packs. The government announced a review of the pre-pack measures on the 12th of December 2017, and essentially there were three options available. Firstly, do nothing and keep the status quo. Secondly, we prohibit connected party sales. Or finally, introduce statutory rules on connected party sales. But importantly, this is around general sales to parties, so it is much broader than some of the issues that are identified in the Graham review. Although 5 years, this power would expire on the 25th of May 2020, so 5 years for the government to take action. Whilst 5 years seems like a long time to review the need for change, it's been a fairly dramatic 5 years in the UK. We've had 3 prime ministers, 2 general elections, a referendum on exiting the EU, and now we're in the middle of a global pandemic. So perhaps it's not surprising that the power lapsed without being exercised on the 25th of May 2020. As a result, there's potential risks of the Graham review reforms and the future of the pool. And Theresa Graham was quoted in the Times recently saying that to see the demise of the pre-pack pool would be utter folly. So this appeared to leave a predicament. The pre-pack pool was written to Lord Callanan in May, expressing concerns about the future operation of the changing approach, and it's been reported that it's facing some financial difficulties of its own because of the lack of referrals. The lack of government action suggested that reform wasn't necessary, as Lord Callahan's reply to the pre-pack call on the 29th of May states that the current system, including potential disciplinary action faced by IPs, was sufficient. However, in response to the current COVID-19 pandemic, the government has used the fast-track legislation process to enact the Corporate Insolvency and Governance Act, and the matter of connected party sales came to the fore once more, eventually. So, is there therefore a second chance for pre-pack reform under the Corporate Insolvency and Governance Act? In late March 2020, the government announced that it would be bringing forward legislation to help with the COVID-19 pandemic, and we saw the bill introduced on the 20th of May 2020 and then enacted on the 25th of June. Now, I'm not going to go into too much detail because I'm conscious that my colleague John Tribe spoke to you about the Act recently on this platform, but I just want to say that two of the key reforms introduced that John would have talked to you about are firstly the standalone moratorium and secondly the flexible restructuring plan, or the cross-class cram-down. So the bill also provided an opportunity for the government to revisit regulation of pre-packs, but it didn't. However, the expiry of the sunset clause received significant attention in the House of Lords, with a number of amendments suggested to address the oversight of connected party pre-packs. These suggestions included Baroness Neville-Rolfe's suggestion that paragraph 60A be revived with a further year for action, and Lord Hodgson of Astley Abbott's inclusion of a new paragraph 74A that would mandate referral to the pre-pack pool if you wanted to pursue a connected party sale. Now, the government's position was that strengthening the professional standards and existing regulation were fine, and if they didn't deliver increased critical confidence, then the government could bring forward further legislation. But not addressing this pre-pack issue had the real potential to undermine these new processes. As Lord Hodgson observed, no one will prefer to undertake a highly regulated moratorium if they can get away with a virtually unregulated pre-pack. Why not? Well, pre-pack essentially offers the opportunity to leave most of the debt behind in the old company, carrying on the business through a new company. So why load your company with unnecessary debt as you'd have if you, say, for example, took on a moratorium and then looked for a workout through, say, a company voluntary arrangement? Especially in the current situation where we've got so much uncertainty. As Lord Mendelsohn observed, pre-packs are everywhere at the moment, and I can see their footprint increasing at some pace. The government eventually conceded and introduced its own amendments to extend the sunset clause to 2021. If nothing else, the House of Lords debate provided some memorable quotes, including this from Lord Mendelsohn in summing up his argument that maybe this proposal lacks the support of a prominent footballer, but I hope the strength of the comments of the noble lords will not be lost on the minister. Apparently it wasn't, and the sunset clause has been prolonged. So what next? Well, the pre-pack remains a key tool. As Lord Hodgson commented, I suspect he chose his words carefully, it's a useful spanner in the toolbox of the insolvency practitioner. However, they are open to serious abuse. Unsurprisingly, as we emerge from COVID-19 enforced lockdown and the economic consequences of the shutdown and withdrawal of generous furlough scheme and other reliefs available to businesses that have been struggling, the pre-pack is making a resurgence with a number of recent high-profile cases, and no doubt a number of lower-profile cases too. So the question is, will the government now exercise the extended paragraph 60A power, or will fears such as that of Lord Vaux that the government didn't use the power for 5 years, so he has limited confidence that it'll do so within another year, be well-founded? Hopefully not. The government has belatedly acknowledged, as Lord Callahan said in the House of Lords, that there may be a risk of an increase in the use of pre-pack sales, which could adversely affect businesses already struggling as a result of COVID-19. And he went on to state that ahead of using this extended power, we will publish the government's review of existing voluntary measures in respect to pre-pack sales this summer to help further inform the public debate on the issue. So it looks like the government's taking this seriously and there will be action. So what then are the options? We briefly touched on these a moment ago, but let's look at them in a bit more detail in the remaining time we have. So firstly, it could do nothing. That's possible, but surely not. The problems identified by the Graham Review haven't gone away, such as the headline from the Times on the 4th of July on your screen indicates. Unless the government falls back on its previous position that strengthening professional standards and regulations should be adequate, and if not, legislation could be introduced at a later date, a sort of manana, according to Baroness Neville-Rolfe in the House of Lords debate, then it's likely that some sort of action could be taken. Could it prohibit connected party sales? For that's what the power relates to. It's not specific to pre-packs, but rather sales to connected parties more broadly. That seems highly unlikely in a case of throwing the baby out with the bathwater. Even the staunchest of critics in the House of Lords debate recognise that pre-packs offer benefits, and the concept of a second chance underpins the Enterprise Act 2002 reforms on which the current administration regime is based. So perhaps some sort of middle ground, so limiting the freedoms that are currently enjoyed. That perhaps seems likely, but the question is how? Well, that's the $64 million question. How could that happen? On the one hand, we have the pre-pack pool, it's established, it has its expertise and its supporters. So could you make referral mandatory? This is certainly a position put forward by a number of the Lords amendments discussed during the passage of the Corporate Insolvency and Government Bill. But how would this work? Would the pool need to give a positive response, or could the insolvency practitioner exercise commercial judgment in the interest of the immediate benefits of creditors? The opposition to the pool that we see is generally not around the pool itself, but rather the inhibiting effect of having to seek approval, such as discussed by the article I referred to of Nick O'Reilly on LinkedIn, but also we see the responses to the 2010 consultation. However, there's also a further factor raised by Lord Callanan that could restricting supply of opinion to the pool raise issues of anti-competitiveness. It's very much a case then of watch this space. What's he certain is that something needs to be done. What that looks like, we have to wait and see. I'd like perhaps to go slightly further and expand that to a review of the role of deferred consideration, especially where that isn't secured. Although the Graham review suggested that it's usually paid, the delayed payment of deferred consideration has consequences. There's wasted time of the insolvency practitioner and wasted fees chasing the payment. There's also the cost of enforcing any security that has been given. There's also the time and delay of reaching a settlement with creditors. And it could potentially lead to the insolvency of the new co, partly because of having to find that consideration, but also because of the distraction that these sort of discussions can present. And these trends appeared in a study that I conducted that I referred to earlier into 2013 connected party pre-packs. Also, we look at other rescue mechanisms such as the company voluntary arrangement. We see that these are often eschewed in favour of the pre-pack as the company couldn't fund the CVA. Yet the same company can often fund deferred consideration. Or sorry, the same business can often fund deferred consideration. So that brings us back to the nib of the present issue. Without reform, the availability of connected party pre-packs without any firm controls will undermine the efficacy of the new moratorium and existing processes such as CVAs. This therefore threatens the very measures that have been introduced intended to assist the recovery of businesses following the impact of COVID-19. Surely the government doesn't want these major new legislative interventions to fall at the first hurdle. The use of pre-packs in the current climate may not represent abuse, but it certainly represents a spanner in the works for corporate rescue. Thanks very much. I'll hand you back to Jason now and stop sharing my screen.
Thanks, Chris. That's given us a great overview of what's happening in the UK over the last few years and where we're up to now and where we might be going in the future. There's certainly a lot there for us to discuss. I'd like to just hand over to Mark to give us a local perspective on this, and then we'll go to the Q&A part of the presentation. Mark.
Thanks very much, Jason. I'm sorry for turning my video off. I've now activated my alternative webcam. I might have to do it on audio only. Sorry about that. I turned my video off at the start to assist with the connection. You hearing me all right, Jason?
Yes. Yeah.
Yes. Thank you. Got to thank Chris for those comments. And I think one of the few positives of this COVID pandemic is the opportunity, as Chris mentioned earlier, to have these sorts of forums and get quite interesting speakers from jurisdictions such as the United Kingdom. And I just wanted to thank Jason and University of Sydney for inviting me to participate tonight, and thank Chris for those very interesting and informative comments. It's quite an informative update on where things are in the United Kingdom with respect to pre-packs. And it's interesting that it's still a space that we're watching in terms of how ultimately the problem child of the procedure, as I've often described it, the connected party sale, is going to be addressed, and how abuse is going to be prevented. I have written on pre-packs some years ago. I had to take a bit of a step back because I was being accused by some academic colleagues of an obsession with the topic. But my interest in pre-package administration very much had its genesis during my own time in the United Kingdom, where I practiced as a solicitor there. And coming from a jurisdiction like Australia, where our general law independence standards are so strong and entrenched, it was quite an eye-opener for me to see pre-packaged administrations up close and personal, and being able to see what could be done. And so when I came back to Australia and entered academia, I had very much pre-packs in mind as an area that I wanted to research and consider, and hopefully make some thoughtful contributions to the debate here, because as Jason mentioned earlier, we're always in Australia been looking at how to improve our own system, especially in SME insolvencies, how to improve our regime and improve the outcomes that are generated by it. So when I came back to Australia and started looking at pre-packs, and I must say I do have some problems with the position of the insolvency practitioner and independence issues, and I don't think our stringent independence standards in Australia are a bad thing, quite the opposite. But when I came back to Australia and started looking at pre-packs, my attitude and my approach is very much to have a look at how we could make some of the good aspects of pre-packs work in Australia without the obvious potential for abuse. So how could we make them work better, given the environment in Australia where we do have quite strict general law standards of independence? And I think importantly, and Chris made this point earlier, an important point to understand at the outset is that the pre-pack in the UK, and I'm talking about UK style pre-packing, is not a regime that one can identify or point to in terms of black letter law or a part of the Insolvency Act of the United Kingdom. It's a practice that emerged. And I think what Chris has taken us through is an interest, from our perspective in Australia, is a very interesting case study in insolvency practice vis-a-vis law design, or insolvency practice emerging as opposed to considered reflective design of a procedure, because the UK pre-pack did not come about from Parliament sitting down with forethought and careful consideration, designing and calibrating a regime. From my perspective, the question needs to be asked why, when we're still looking at what possible regulation, or for instance, conditions of creditor approval or court approval are still being considered in the UK, why that wasn't introduced into the pre-pack mix at the very outset when pre-packs first emerged. And of course, the answer to that is, it's not a regime or a considered law design. It's a practice which has emerged. It was in effect allowed. They went to court, as Chris mentioned early on, and the use of the power of sale just after an appointment was allowed by the court, notwithstanding that the insolvency practitioner has been substantively involved with the director's pre-appointment. So I think that's an important point to bear in mind, that it is a practice as opposed to a considered design. And I think from the Australian perspective, if we want to be considering the use of pre-packs, we need to ask the tough questions, and I think advocates in the space need to answer some of the tough questions about how that would be done in Australia. We see in some inquiry discussion papers references to the notion of implementing pre-packs. Well, how does one implement a practice which is allowed in the United Kingdom, which is not allowed in the how do we implement in Australia a practice which is allowed in the United Kingdom but not allowed in Australia because of our strict independence standards? So to my way of thinking, all roads simply would lead to legislative override of independence standards. And I think, one, there's a debate about whether that should happen. And secondly, I think that's a tough sell for any politician to see that crystal clear in a bill, to lend support to that in Parliament. I think that's going to be a tough sell. And so I think implementing a practice like that, and simply the whole notion of transplanting a practice which is emerging in the United Kingdom into Australia is optimistic at best. And we need to think, I think, well, take stock of what's happened in the United Kingdom, look at that experience and see whether that whole experience of a practice emerging, wringing of hands about potential abuse, a voluntary regulation which hasn't really been taken up or worked, and now we're in a situation where still it's a space that we're watching. It's unresolved. You know, an odour still seems to be emanating from their use. I don't have any empirical data on this. Chris might have some opinions on this, but I'm not sure to what extent confidence in the system's been compromised. But clearly, there's an element of unsecured creditors in the United Kingdom who still have issues with pre-packs. So it's an unresolved issue, and I think it speaks volumes for the wisdom in having a look at how we design regimes rather than letting practices emerge. So I think it's probably clear from what I've just said that I don't necessarily see pre-packs as a panacea, but I think it's always good to look at what's happening in other jurisdictions, to take stock of our own, see what outcomes we're generating in Australia, what can we do better, and how could we improve our own VA regime to achieve better outcomes for all stakeholders, not just creditors. And I have to say, my experience in the UK was that the pre-pack, certainly the connected party pre-pack, tended to merge into or morph into a commoditized solution, which was more for the benefit of the owners and directors of a business rather than creditors. Obviously, there's significant disenfranchisement of creditors and a lack of participation. So I think there's those issues as well with pre-packs. But I think in Australia, I think there's a consensus that our system could still be doing a better job. And I was very interested in what Chris said about the moratorium, the new moratorium that's been introduced in the latest raft of reforms in the UK, because for some time, my theory, and it's only been a theory, was that in the United Kingdom, I think it was at the Enterprise Act or very shortly thereafter, Chris will correct me, but there has been for many, many years a debtor in possession small company moratorium procedure in place, which could result in a CVA, which is the UK equivalent of a deed of company arrangement. And that, in effect, in the latest raft of reforms has been extended to companies other than small companies. The experience in the United Kingdom, which is often pointed to, is that small company moratorium regime was never really taken up. It was never utilised with any sort of degree of prevalence. And I think Chris has identified the reasons there, which I always suspected was that if you're a director of an SME and you can do a day one pre-pack, why would you utilise a moratorium procedure leading to a CVA where you've effectively got to get creditor approval, and creditors would obviously want you to look at other options such as an extended workout, generating a better return or outcome for creditors. So my view has always been that small company moratorium regime is something well worth considering in the Australian context, because we do have a more restrictive environment with the use of pre-packs, but it would offer an alternative for directors in the SME space to use a monitor rather than a belts and braces external administration to get the benefit of moratorium, put a proposal to creditors and achieve a deed of company arrangement, which my own view is always, in many cases, I should say, the ultimate outcome or honourable compromise between directors and creditors. So I find those comments that Chris made very interesting about the moratorium, and it's interesting, again, that Chris has said that really trying to clean up the issue with pre-packs, particularly the connected party pre-packs, is very much a piece of or a necessity to make these new reforms in the UK work as intended. And I think it's, again, something we can consider here in Australia. So I think in the interest of time, Jason, I might leave my comments there. But before we went into Q&A, I wanted to maybe just throw back something to Chris that just having been through the whole experience, through that point I made earlier about creditor confidence and stakeholder confidence in the system, if you sort of had your time over again, Chris, and by you I mean the United Kingdom, from a lawmaking perspective and a law design perspective, you've taken us very well through the iterations of hand-wringing, if I can use that expression, the concerns about the use of connected party pre-pack sales. Yes, they achieve great outcomes in many cases, but they have problems. It's been many years now and it still doesn't seem to have been resolved. I guess, firstly, how do you think it might have been designed, or how things might have been gone about at the outset in retrospect? And I guess secondly, I mean, has it all been worth it? I guess I was going to ask, I don't know here, has it all been worth it? is this whole experience, and some impairment of confidence in the system seems to have occurred, but have the benefits of pre-packs, the benefits of pre-packs generally seem to have outweighed those concerns. I would just be interested in Chris's sort of insights on comments on that, giving him some right reply too on what I've just said about my perspectives anyway on UK pre-packs and what perspectives we can draw upon in Australia. But as I said, I value Chris's comments, and I think what he's taken us through has been a really good, informative update. And I might leave my comments there, Jason, because I want to allow some time for attendee questions.
Great, thanks, Mark. Chris, did you want to respond to Mark's point there?
Yeah, sure. Thanks, Mark. Some really interesting points there. Which could just you mentioned earlier about the small company moratorium. You're absolutely right. In 2000, the small company moratorium for companies looking to go into a CVA, so allowed a 28-day. However, it just never took off really. So I think that the CVA project that we did for R3 and the ICAW in 2018 revealed that of 554 CVAs that started in 2013, only 8 made use of the company moratorium, despite the fact that 91% of companies using a CVA were eligible to do so. So it just never took off for various reasons, which I won't go into now because time's against us. But similarly, those problems could, undermine the new moratorium, which is wider. And incidentally, that small company moratorium for CVAs has been repealed. The moratorium is far wider and still has the same outcome potentially. As to the how would we do it differently? We were designing it. Got a platform to speak for a nation there. Because the pre-pack is such an important tool, and even as I mentioned in my presentation, that sort of staunchest critics even see the benefits of it. So how would you design it? It is difficult. It does seem to run contrary to some of the intended outcomes of the administration regime as set out in the statute. So I think there would have been a very different view of how administration would work. Interestingly, in Holland, in the Netherlands, they have sought to introduce a pre-pack on a statutory footing. I'm not totally sure as to the latest state of that. They introduced a few years ago the Continuity of Enterprises Act that was working its way through Parliament. So it's a difficult one really, because it's hard to imagine the landscape without it. Hard to imagine how you design it from the off. Is it worth it? I think the prevalence of the pre-pack shows that there's certainly a place for them, and acknowledged to deliver a lot of benefits. And I think that the key thing is to work within that framework and try and eliminate the abuses. So I think the preservation of jobs and the economic sort of balance you get from that, it certainly has been. And we've seen trading administrations just decline over time, generally due to the expense. And as you've sort of seen the change in the nature of businesses as well, so their asset profile. So we're moving away from physical asset companies to companies with a lot of intangible assets. I think that's well. So I think in some ways the pre-pack does allow a maximisation of value there, but it's just making sure that that value is maximised. And I think that comes down to the proper valuation and marketing to ensure that the best deal is obtained.
Chris, would you mind just repeating what you said about the Dutch reforms? The audio was a little bit patchy when you were mentioning.
Yeah, sure. So the Dutch were introducing something called the Continuity of Enterprises Act. I looked at the latest status of it.
So, sorry, Chris, I think the Dutch might be putting the kibosh on you explaining their new law. I'm not sure.
That might be the answer for us. So it was the Continuity of Enterprises Act was sort of making its way through the Dutch Parliament. But I'd say I'm not totally sure as to the latest status of that. I'd have to sort of follow up on that. But I looked at that a couple of years ago, and it was sort of stuck in parliamentary debate at that point.
Yeah. Well,
I did find that the Section 60A possible sort of solutions interesting when there's a reference there to creditor approval, because that is a CVA.
Yeah.
And yeah, anyway, just thought I'd throw that in.
Okay, so we've got a few questions here. We've still got a few minutes, so we might just go to the questions. So one question is for Chris, and that's about, is there any data on the position of secured creditors with pre-packs? Where do secured creditors fit into this?
Yes, so the Graham review included some review of the position of secured creditors and returns to secured creditors, and that was unsurprisingly generally better than unsecured, and particularly if you had sort of debt financing of some sort, so debt factoring or invoice financing. So those sort of creditors tend to do very well, including payment of any termination fees as well. I did a follow-up paper that was published last year in ICCLR, looking at the comparison of pre-packs and CVAs, sort of touching on the point that Mark recognised about why would you do it for CVA pre-pack almost, and looking at the outcomes of those processes. And again, that sort of looked again at the outcomes for secured creditors compared to unsecured, and broke that down by the creditors as well. So there is some data there. They generally do well, but not universally. So you do sort of see shortfalls in unsecured payments. A number of these pre-packs are very much the lower end of the market, with considerations between sort of £10,000 and £50,000, and in those cases often there isn't a secured creditor of any note. So some of these sort of fall under the radar of secured creditor.
Chris, just Jason, if I may, just on the topic of secured creditors, one point I forgot to mention earlier, and I'd be interested in Chris's perspective on this. I've always found it a bit of an oddity that in the United Kingdom, they abolished administrative receivership, which is the equivalent of our receiver and manager style external administrations. And my understanding was the abolition of administrative receivership was to promote collective insolvency procedures and collective creditor participation. Yet about the same time, pre-packs emerged, and it would seem to me to be sort of almost the antithesis of collective creditor participation. Is it just me, or is that just a little bit? I know, as I said earlier, one was sort of designed to the abolition was a decision of Parliament, the other is a practice. But do I have a point there in sort of observing that it is a little bit odd?
Yeah, I think you've definitely got a point. There is the distinction that can be drawn. So the administrative receiver owes its duty to the appointer rather than to the general body of creditors. So the insolvency practitioner in executing a pre-pack has to be content that it's the best outcome for all creditors. But obviously the creditors don't get the opportunity to become involved. Although, going back to the early point of my presentation, that stems from a decision of the courts before the abolition of the paramount situations. They felt that early action would be better for the creditors, than they could take that early action, though there is that sort of requirement for them to try and engage with as many creditors as they can in the time available. So yeah, I think the point you raise is a valid one. There is a slight distinction, but yeah, it certainly undermines some of the principles of the administration process. Although, as I said, the courts understood that there's a quid pro quo between balancing creditor engagement with commercial judgment around maximising creditor.
We've had an interesting question from the audience about whether, in the opinion of the panel members, whether pre-packs can work in jurisdictions like India, where the insolvency profession really is still developing, having regard to their recently enacted new Insolvency Act. Does the panel have any views on that? In developing nations where the insolvency profession is still developing, are pre-packs a no-go zone because of independence concerns and fraud concerns, or is this something that perhaps, having regard to that commercial benefit you've been talking about, Chris, could provide some quick wins for local restructuring?
I think my opinion would be that for a pre-pack to be a viable offering, you need to have some level of regulation, whether that's on a statutory footing or on a professional regulation basis. So, the UK position has always been that the sort of professional regulation has been where the controls lie, and we're now moving towards potentially some statutory footing on what happens with regard to paragraph 60A. But all of the developments historically have been around regulation. So, if you don't have that professional regulation, I think is you need to have it on some sort of statutory for that protection.
I see Pete Walton's asked a question, which is Australia as worried about World Bank rankings as the UK government appears to be? Mark, do you have a view on that?
I don't actually. I mean, I was involved in an ARETA webinar last week where I mentioned that I think World Bank reports and guidance on lawmaking and law design are very useful tools and very useful points of reference, but not necessarily something to be followed slavishly because every jurisdiction has its own nuances. In terms of rankings, yeah, look, I actually don't have a firm view on that.
Okay, so we're just ticking over to 7 o'clock. There's still a couple of questions here, which I'm not sure we're going to get an opportunity to get to. Chris, in your presentation, you mentioned a number of different papers and reports and things. If I could ask, if you wouldn't mind, if you could email me just the citation details for those, and if you've got any of those reports that you've been involved with on your website or something, if you can send through a link. And then what I'll do with the slide that I'm sharing, I'll do a second slide which has all of the details, and then we'll be emailing that out to people today, tomorrow, or the next day. I might just finish with a comment from Scott Hedge here. And Scott says this is a comment rather than a question. He says, in Australia, we seem to spend all of our time trying to prevent Phoenix and in theory to protect creditors, but the UK seems to do the opposite. He finds it amusing that the pre-pack pool is composed of experienced business people, and he questions whether any of them would ever look askance at any deal. He also notes here in Australia, where am I up to? Here in Australia, often the people inside the tent who are doing these restructurings can't see what's wrong with it, even though people outside seem to have what he says is an endemic institutional distrust of directors and insolvency practitioners, which causes huge issues in restructuring and corporate rescues. Chris, I just wanted to thank you, and also thank you, Mark. This has been a really fascinating discussion. It's a huge topic. We could easily spend a whole day just talking about pre-packs. Chris, you've given us a lot to think about. In Australia, these are issues that we're coming across in multiple significant matters. Of course, at the moment, Chris, you might not be across this, but we're having multiple media stories every day about the restructuring of Virgin, and there's been an awful lot of discussion about the sale process, who's inside the tent, who's outside the tent, and how sale processes for large and complex businesses operate. Now, that's not a connected sale per se, and it's certainly not an SME sale, which is mostly what you've been discussing, but these competing interests of trying to give transparency, trying to give creditors voice, adequate information, and also try and give them some return in difficult circumstances of insolvency and restructuring certainly are playing out here, and will no doubt continue to do so into the future. So thanks very much for sharing your experience with the UK with us, Chris, and thanks very much, Mark, as always, for your expert comments on these matters.
Thanks, Jason. Thanks, Chris.
Thanks, Jason. Pleasure. And thanks, Mark, as well. Thanks for your comments.
So for the attendees, this is a recorded session, so there will be a video of this that will be circulating to everyone who's registered, as I said, in addition with the relevant links there. So look forward to that. If you've enjoyed this webinar, Sydney Law School has a number of webinars which are coming up over the next few weeks. Next week, on the 22nd of July, we're going to be running a webinar looking at corporate governance and COVID, with a particular focus on corporate social responsibility and directors' duties. We have a guest presenter from Taiwan. And then we also have a webinar coming up on the 29th where we'll be discussing current and potential law reform of continuous disclosure obligations. So thanks everyone for giving up their time. Apologies, we had a few audio issues there. These things can come up from time to time when we're using Zoom, but I appreciate your patience, and thanks very much to the presenters and the attendees.